Okay, welcome to this first edition from my next Forex trade. I'm just going to go over some setups that I see in the market. Not necessarily, in fact, not necessarily setups. It's just to give you guys an idea of how I decide personally on a trade. I think of it as shopping. So when I'm looking through the charts here, I'm looking for good value for money. And if there isn't an opportunity there, then I pass on it. So it's just going to take you through my thought processes. I mean, typically for me to scan the market will take about 15 minutes or so. It's probably going to take a lot longer as I explain it. But hopefully you'll get some value from this and get some insights into how to look for trade setups. So firstly, just a breakdown on the charts that we've got here. Let me just declutter this a little bit and just take off these alerts. So the reason I'm looking at this one first is because this is the one that I see potential in trading, and we'll look at this first and then go through some of the other ones as well. This one that I've got on the screen here is the US dollar against the Japanese yen. What you can see here are 5 different timescales that we've got. So we've got the date. No, hang on. Let me just change that back. Something's gone wrong with these. One of the issues with live streaming. So this should be my daily down here. So just give me a second. I'm just going to sort these out. One moment. Okay, yeah, I knew something looked a little bit weird there. So this is my daily chart here. This is my 4 hourly. This is the hourly. This is a 15, and this is a 5 minute. So one of the things that I look for is time frame correlation. So I want all of the time frames to be saying a similar story. So starting with the daily, what I'm looking for is some evidence that there's a trend in place. You know, there's the old saying, trend is your friend. And going with the trend is a lot easier than trying to go against it. So I'm looking for some momentum that I can jump on the back of. So on a daily, on the USDJPY, let's take these off for a sec as well. Just clear all, declutter all of this. So on the daily, the first thing that I can see, it's a snapshot, is that we have had some downward movement. So there have been lower highs and lower lows as well. There has been this movement upwards recently where it has started to create higher highs and higher lows as well. But I'm not super concerned of that because of the context that it's happened within. So one of the ways that I look for value for money is to, in terms of seeing whether it's bought or oversold. Let's move away from the mic a little bit there. Is to use this tool here. This is a standard deviation channel, so you can get this in MetaTrader from your charts. Where is it? No, it's under insert and then indicators. No. Sorry, it's still quite early in the morning here, so I'm not thinking 100% clearly. This is a channel, so yeah, so it's under channels, standard deviation channel. So what I've done here is put this around the most recent downward move, and standard, I don't know if you know how standard deviations work, but basically I won't go into how it works exactly at the moment, but basically you've got an area where when it's reached an extreme, it has a tendency to move back towards the mean, towards the average. So this this line in the middle is basically the average, and these two extremes are either side of where the channel are showing where there's one standard deviation away from the price. So the concept here is that once it's kind of hit an extreme, either on the upper edge or the lower edge, is that it has a tendency to move back towards the average, which is this area here in the middle. Kind of like when you pull an elastic band and it gets too tense and you let go, bang, it comes back to the middle. It's kind of the theory that that this is based around. So we've got downward trend. We've got the price being over bought at the moment, which gives me at a snapshot some idea that this could be worth looking at more on the lower time frames. So what I would then do is drop down to the next time frame, which is our 4 hourly, which is this one up here. And I would do something similar. I'm just trying to see if there's, obviously this move here is the same as this move here that we're seeing. So anything that you see on a smaller time is always going to be a more granular move of what's happened on a higher time frame. So we can see that this movement that we're looking at here, there's more candles that create this than in this movement here. This move here on the hourly is essentially this move that we've seen here on the 4 hourly, right? But there's more to it, if you like. If you zoom out, you can see there's some information that we can't see on that on the hourly that is on the 4 hourly, and so on and so forth down through the lower time frames. It just gets more and more granular. I digress. So let's go back to what we're looking at on the 4 hourly. Looking for it to be overbought so we can short this. We're looking for to sell this in the anticipation it's going to move lower. So I can see that it's echoing what the daily was saying. And what's interesting in this is I've put this same standard deviation channel around this move up here, and it's broken through this you've seen recently, and it's retesting it. It's almost coming up, well, it is coming up, and it's finding resistance off of it. So that's interesting for me because it just gives a good reference point for an entry. So I'm going to remove some of this here. So we can see that, there's a few things that stack up in terms of building a case that this could move lower. And always use the word could because you never know what exactly is going to happen in the market. We're just trying to build a case to short this, right? So you can see that it had broken through that linear regression channel. It's come up and it's tested it here. We can see that the previous levels here kind of gives some evidence that there is some resistance at this level. So it's hitting what was previous support there is now turned into potential resistance. We can't tell until this 4 hourly candle has closed properly, that's going to be a super strong level of resistance. So if in this candle that's forming here, if it comes up and tests this level again and then falls away, that's even better indication that this is quite a strong level of resistance. But we've got enough evidence here based on what the daily and the 4 hourly is saying to at least see what the lower time frames are saying as well. So the hourly in this case here. So what I'd be looking for on the hourly is again just it's more of an entry point, whereas these were kind of the bigger picture. Is this worth looking at? Is this worth my time? With the daily and the 4 hourly, the hourly is more okay, right, we've got some indication this could be a trade. How is there an entry on this? So what I'm looking on these lower time frames is for evidence of the price creating these lower lows and lower highs on these lower time frames. So we can see that there's on the day, in the hourly here and the 15-minute, there's some good indication that there's going to be some bearishness, and it's tradable in where the price is at the moment. So, and if I pause in this, I apologize. I know it can be annoying as a listener, but it's just because I'm thinking. When I trade, like I said, I usually take about 15 minutes to go through the whole, cycle through the whole market. There's several charts I look through, and this approach to trading here is quite new in terms of the way that I've developed it to make it easier for kind of swing trading. So for me, it takes a few seconds, and I have to pause and think how to articulate that for people who may not be so familiar with it. So apologize if there are lots of pauses and ums and ahs, but hopefully that will get more smooth as I get better at this. So let's just have a look here. Okay, so the way that I would structure this trade here is that I can see an entry point in that I'm thinking, where can the stop loss be? Because the first thing is basically, okay, there's decent risk to reward on this in terms of an entry. How am I going to protect my capital if shit hits the fan and this goes against me? So in the downtrend, we're looking for lower highs, and one way that you can protect your capital and have a clear indication of where you're wrong on a trade is looking for those lower highs as an area to place stop losses. So above these lower highs is a sensible point to consider placing stop loss. So in this downward movement here, this is a lower high because it's lower than this previous one. This point here is a lower high because it's lower than this one, and it's just creating a lower high here because it's lower than all of the previous ones that we can see. So one way you could approach this would be to short this with a stop loss above here, and if this were, say, a 1-to-1 risk to reward, it would mean that the pips stop loss on this would be about 13. So if you can see where my cursor is here, the reason I'm reading 13, if you can see there's a 7, then a dash, and then 13, and then a dash, and then the price. 13 shows you how many pips there are. So as I move this up and down, you can see that middle one move. Now, you could approach this by taking a short for this based on a stop loss above that level. And I mean, going for a 1-for-1, so one risk to one reward, it would mean that, just eyeballing this, that your take profit is going to be around here, right? And that stacks pretty well. I mean, even if you're going for 2-for-1, so we'd be looking for about 26 in terms of taking profit, it would be around about this level. So on this area here, which for me isn't great taking profit right there. Why? Because it's bang on the support level, and as a price approaches support, it has a tendency to bounce away. So that I mean, it stacks in terms of a 1-to-1. It stacks in terms of the profit potential, and it makes sense in that you protect your profit, having a stop loss above this previous lower high. Now, for me, that is one approach to doing it, and you could viably create a strategy based on everything I've said so far and taking entry like that. If you are slightly more conservative in the approach, there are other things that I would take into consideration. A stop loss above this level here isn't great for me, because if we look back to what this would have meant on the just delete that, on the higher time frames, it's not as great in terms of protecting the capital. So I'm just going to put in alert just so that we can see how that appears on all the time frames, right? So putting in a stop above here makes sense on the hourly, because obviously it's this lower high. But when we look at it on the 4 hourly, it's not that great, because we can see that, I mean, it's still in this kind of danger zone. It could easily, in a bat of an eyelid, move back up into this kind of area and we'd be stopped out. But in the sense of the 4 hourly, we're not really wrong. We haven't given enough breathing room to be wrong, really. if that makes sense, because it's still moving in a downward channel. It still hasn't gone higher than the linear, the standard deviation. So we could be wrong. We could be stopped out on this, but still be right overall in terms of the direction of the price. So the more cover all bases type of stop loss would be above this kind of level here. So if I put in this alert here, and the only reason I use the alert is because it shows up on all the different time frames, and you can easily at a snapshot see what's going on. So a stop loss above this type of level, which is this high on the hourly, means that you've got a protective stop outside of all the 4 hourly, also on the daily, and above this lower high here, and it just covers more bases. So it's like in poker when you have the concept of outs in terms of the amount of ways that you can win, if you like, in a game. The more combinations that the cards that you have in your hand could have, the more chances you've got of winning. In this instance, you've given yourself more outs to make money. In that, putting your stop loss in this kind of safety zone, inverted commas, means that you've kind of given yourself a little bit of wiggle room in terms of what could go wrong, and you've still got profit potential as well. It does mean the market will have to move a lot more in terms of you making profit, but it's a higher probability profit. So the way this would stack is that we would need a stop loss about 62, 63, and I'm adding a bit of extra to it because of the spread. So this is another thing to consider. If this I don't want it to be bang on this level, right, because the spread is the difference between the bid and the offer. So I want it to be just comfortably above it, not way up here, but comfortably above this resistance zone, just a few pips. So I would say from our entry point, which is this white line, dragging it to above this previous lower high here, we're looking at about 64 pips, 65 pips. Let's call it 65 pips. And again, it's not really an exact science to this. Never really try and be pip perfect in terms of your entry and exits. Just have a bit of leeway. Yeah, the way the Forex markets works as well, it's a decentralized market, so a lot of the times the prices you get are, it's just give it a bit of leeway. Don't think in terms of pip perfect entry. So this entry here would mean that we would have a profit target of around 65 pips. Again, I'm just eyeballing it around here. So our risk is up here, safely above these previous lower highs and resistance that we're seeing from the channels. And our profit target is on a 1-to-1 reward to risk is at this level. Now, this stacks as well because going back to what I was talking about with the standard deviation channel, this is the mean, this is the average. So we're taking profits before it hits the average, which is just thinking in terms of probability, how likely you to make a return on the trade. It's more likely because it's just a lower again, higher probability type of risk, type of trade, lower type of risk. Think of it in terms of this. If we had an entry which meant that we were entering here, right? Let's compare it to entering here, and I'll go over this in some of the other ones that we'll look at. But think of it if you were taking an entry here to short and a profit target, way out way beyond this lower linear regression channel. Now, it could still come through, but it's just less probable because you're selling at a time when the price is already oversold down here. There's not as much value for money, and you're going for a profit target that is less probable because it has to really stretch down and break through, you know, to make new lows. Whereas up here, it's kind of within the course of things. It's, you know, it's overbought, which means it has a tendency to come back to the average here. So you've got a higher likelihood of, you know, making a return, and really that's part of, you know, your job as a trader is really to make those trades that that stack up and can give you a return again and again and again. Doing those type of trades where, you know, it's higher risk down here where it's oversold, yeah, they'll come out a few times, and you know, you may get lucky a few times, but in the long run, it's probably going to have a you know, bigger impact on a negative impact on your account, and taking these higher probability type of trades here, where you know, you've got things stacked in your favor. You've got more outs in order to make your profit. So just okay, where was I? So here, so yeah, let's see how I'd go about calculating this. So we're looking at this. We can see we've got a nice potential for a 1-to-1. The next thing I'd be looking to do is just calculate how much of an entry would be. So the price on this at the moment, what we're looking at, 108. Okay, so I'd be thinking on this, there's some good points to this. It's this for me is a 1% type of trade. Typically, each of the positions that I'd take would be about 1 or 2%. The reason this is a 1% is because there's a slightly more risk in that, you know, if I had an entry that was up here, and I had a nice reversal candle up here, for example, here, when this happened, and I'd seen that entry, that for me would be more likely a 2% type of trade, because our stop loss would be up here, and you know, 1-to-1 would mean that an exit would be around here. Here it's a little bit later in the move. It's not bad, but it's not as great. So for that, it's kind of evaluating that and saying, right, this is, you know, this is 1% rather than 2, because it's not as good. So the market has moved a bit, so let me just double check. All right, I'm still gonna go 65 on this. So the way I'd figure this out is, I don't think you can see my calculator come up, but I still do this old school. There are loads of apps. I mean, I'm super great on Excel spreadsheets and JavaScript, so I could easily create a tool to do this, but funny enough, I don't. I always do it manually. It's good practice as well, especially if you're new, just to do the sums on this, just so that you know how a lot size is calculated and what you're calculating. So in this instance, this is going to be 100, and this is one thing I'll come to in a sec as well, is currency conversion. So the basis of this account is in pound sterling, so I need to do a conversion to figure out what it would be for the correct lot size. So I'm going for 100 pips, sorry, 100 pounds risk, and 65 stop loss. I'm doing 100 divided by 650, so I'll just add an extra nought on the end there, because it's a micro lot. So that comes up as 0.15 as a lot. Now that is not the actual size of the lot that I need, because I need to do the currency conversion for pounds, and I can see here that the rate here of GBP/JPY is 135.75, right? So what I'm going to do, because this is denominated, the quote currency is in yen, it means I need to do a conversion because my account is in pounds. So I'm going to take this rate and use the lot size that I need and multiply it out. So it means that I need to do, I'll probably go into this more detail in other videos, but in this instance, I'm basically multiplying it by 13.5 oops, hang on, sorry, my calculator has just gone away. So let's just do this, divided by 650 times, so it's 0.21. Like I said, I'll go over this in other videos, how to calculate this out, but basically this means that my lot size on this in pounds is because I've had to do the conversion, is 0.21. It's going to sell that, and that's a 1% risk. So that means now if I stretch out the stop losses roughly, let's get rid of that now, 1 sec. So I'm going to just manually move this here. You can see, if you look on the right hand side there, I'm just trying. So can you see this amount moving up here where my cursor is? So it's saying 102, 101. So I'm going to put it here. If that comes up, you'll need to just, because this is a fresh MetaTrader that I've set up for this, this message comes up because I'm doing these one-click type of movements. It's confirmed. 1 sec. Okay. So here we've got my stop loss in place. You can see visually that it's above our lower highs on the previous moves, and we're risking on this instance, for just hover for a sec, 1 moment. You can see that the risk on this is roughly £100. Obviously there are other considerations to take in here as well. The fact that there's a commission with this broker that I use, and there's a spread as well. So the price has already gone into profit, but you need to bear in mind, when I initially would have pressed the sell button there, the price would have been negative, because it needs to beat the spread first of all to make a profit. So the next thing here as well is just to take the take profit level. So I'm going to drag this down to roughly £100 profit. So it's 65 pips either way. Now this is something that now that I've got the basis of the trade set up, this may be something that I come back and just assess as the day goes on, because what I would be looking for is potential signs of reversal, which could be an early sign to actually get out. I mean, starting out, I would suggest that you go for just leave your take profits and stop losses exactly where they are. The stop loss, you never want to move. You never want to risk more than what you've set out from the beginning. So if you've set this so it's 1% or 2% from the get-go, you don't increase that risk. You can drag the stop loss down and protect profits so that you're not losing any more. So let's say, for example, this starts to move down, it creates another move here, pulls back, and then starts to move down again. That would mean there'll be a lower high, that there'd be a good reference point for the stop loss. Now that means that if the price were to turn around and start moving up, it would get stopped out, wouldn't be at the full profit that I desired, but it would still be a profit, and it means I couldn't lose any more than I can't even speak this morning. It wouldn't be able to lose any more than the stop had allowed for. Let's get some water here. Okay, so yeah, that's one. Let me just go a bit more granular on why, what my thoughts are on where this take profit is. What I'm looking at on the hourly are these areas here. So my take profit is basically bang on an area which could potentially have some some support as it comes down. And I just know that because I've been looking at charts for thousands of hours. But basically, when it starts to move and makes this, if it starts to move and come and approach this level, I would monitor this for signs of reversal. I put an alert on here just so that I can know when it's past this level here, this lower low, just out of interest, just to see how things are going. Now, managing the stop as well. If this is going back into that concept of having outs, right? So I'll cover that a little bit, and I don't want to go on too much in this first instance here. But if, let's say that we looked at this from the initial kind of idea that I was suggesting, that you had a stop loss above here and a take profit, around here. Now, if the price were to move and you were to get stopped out, it means you've wasted that 1% or 2%, whatever you're risking, and you don't really have an opportunity to do anything else. You've lost that money. With this, the way this is positioned, if the price were to take out that lower high, I'm still in the position. I'm not wrong yet, because the stop's all the way up here. It means that if I were to see the price kind of start to show some pretty, positive signs of moving higher, I still got time to, if you like, fix that. And that could be one of the approaches to that, is moving up the stop to break even, right? So that's definitely more of a kind of an advanced technique. To start with, I would suggest just leaving in your take profits and stops as is. But one way that you could manage this as you kind of get more familiar with the price action is that by seeing the price start to break a previous lower high, is to think, right, okay, I was definitely wrong on this in terms of how the price could move. How can I just preserve my capital? Because what you don't want to see is the price move. What you don't want to be is in a situation where no, let me rephrase that. Worst case scenario, if you've entered like I have here, is that you get stopped out here for your 1 or 2%. Now, if that were to happen, fine, you were wrong on that. But if it were to move, approach this and then pull back, which is a good likelihood as well, because there's a lot of resistance around this and your stop is above that resistance, then you still got the chance to reduce the risk or even just break even, and just preserve that capital, preserve your capital, because that is really the number one goal, right? It is not to make money. It's to be able to trade another day and to get that consistency. Because if the market were to, there's always an opportunity there's another, always, I do apologize for the stumbling. It's super early for me today, and this is the first time I'm doing this, so for this amount of time, so apologies for any stumbles. But basically, the market will always give you another opportunity to trade if you have the capital. So you want to just preserve that capital. So I think I've said enough on this, really, to give you some insight, and there will be other videos. Don't want this to go on much longer, but one last thing I'll add on this. I think I'll leave the analysis for another on the other pairs for another day. I only take 1 or 2 opportunities at a time. Quite a few reasons for that, but one last thing that I will just touch on is where this take profit level is down here. I use a Fibonacci extension to help guide how viable a take profit level will be. Now, you know what? I think I'm gonna leave that for another day, because there's a lot covered today, and really this is just a test to see how things kick off. So yeah, we'll leave it at that today. I'll be back tomorrow with some more analysis, and obviously don't just take my word for what I'm saying. Keep an eye on, for this to be valuable for anyone, it's really important that you take on what I've said and just check on it. I mean, it's easy to see how well this has played out, and how my advice has, or how my opinion has played out, because you're going to be watching this in retrospect. The time now is 7:50 on the 15th of July. So yeah, have a look and understand how this is played out in the way that I'm saying here. We're looking at a live market, so for you to learn from this, look back on these videos and use those to your advantage. All right.